We've got Brandon Lusk from FranFund calling in down from Baton Rouge, Louisiana, the home of the LSU Tigers and home of Brandon, more importantly. And Brandon is a funding consultant that we work very closely with. We love having him be a part of our client's team. We talk all the time about having a team approach. It takes a village to really attack the franchise due diligence process the right way. And Brandon is someone you definitely want in your corner. So Brandon, thanks for coming on today. How you doing today?
Absolutely. Doing great, Brady. Appreciate the shout out for the Tigers. Always love to get a Go Tigers in when we can. But definitely excited and thankful for the partnership that we have, able to help you guys as you're discovering with candidates or just with people that are looking for options in the business world. What can we do? What can we get done? And so we're really thankful to get to be a part. And I'm thankful to get to be here today and kind of unpack what we can do on the funding side.
Absolutely. So the way that I'll tee this entire conversation up is our process as franchise consultants, helping you find the right franchise to own, very similar to working with a real estate agent to find a house. Just like a real estate agent, when we're starting to talk about how much do you want to spend on a house, they're going to have a mortgage specialist that they work very closely with. And the first thing that you're going to do when you look at a house is you're going to get pre-approved for a certain amount of a mortgage with a mortgage specialist. Same type of deal, but we use Brandon and FranFund and his team at that for franchise funding. So before we get into all of that, Brandon, I'd love for you just to be able to share a little bit of your story. I know that you've been in FranFund and in the franchise world for a while, but you've taken a pretty interesting journey. So just before we get into the nuts and bolts of how to fund your business, if you wouldn't mind, just go ahead and share your story, what you've been up to, and how you got into the seat you're at right now.
Yeah, absolutely. Thank you. Thank you for that, Brady. And, being with FranFund now for a little over a year and a half, it's been such an excellent ride for me and such a fun journey to help candidates in their process of how to approach their funding goals. But getting to this seat has also been a really cool ride for me and kind of how I fell in love with the entrepreneurial journey as a whole. I started, one of my first jobs was selling chicken sandwiches. I was just telling Brady before the call, selling chicken sandwiches from Chick-fil-A in Tiger Stadium, and kind of had a friend who was an entrepreneur in that regard and worked with him to grow sales of his own business. And that was one of the first true examples that I saw of someone like putting their passions at play and like, hey, I'm not sure how we're going to make it this month without really getting more sales through their business. And I really kind of fell in love with that spirit. And so the entrepreneurial spirit's been inside of me since at least that I can remember at 15. I'm sure I worked some lemonade stands and stuff when I was younger, but kind of going through that journey and seeing like that true entrepreneurial grit and like how do we get it done, started there, and then worked all the way through college with him and worked to get a freestanding unit open here in Baton Rouge and grew that store. It's one of the largest stores in the state now, and they're still doing great. And then did some other franchise restaurants specifically here in Baton Rouge and helped on the operations side with a small touch of development. And again, kind of fell in love with I'm with my people in this regard. I'm with people that are wanting to start their own business and figuring out how to model it and get it going, and buying into franchising is such a cool opportunity. And so it kind of just opened my worldview of like, you don't have to open up your own lemonade stand necessarily, but if somebody's got the playbook, you can work with them and figure out how to run that play, whether it's in Baton Rouge, Louisiana, Cincinnati, Ohio, where we lost Joe Burrow to the Bengals greatly, or wherever, across the world that you're looking to open these things and run that play for your market. And so kind of went through that journey with them and then stumbled upon FranFund and ended up in this seat getting to help candidates, exactly what Brady was saying, figure out where does funding come into play, and if it is the right fit for me to find funding for my business or to even be in business, how can we help? And so super cool journey to get here and be a part of your process as you journey through it, sort of like the real estate broker, and in the sense of looking at what works for you, what are you looking for? But sometimes it helps to know what you can kind of qualify for lack of a better word, to know, hey, we all want, a lakefront property, or a beachside property, but maybe we need to scale it back and see how we can kind of grow this individual empire one lemonade stand at a time. And I'm going to keep harping on that. That's been my term for the time being lately. But it's like getting one by one and figuring out what works best for you. And, our relationship with Brady has been super helpful in that as we kind of walk candidates through each step of the process. there's a number of different avenues that we can go down and work through, and really ultimately helping you decide which one is the best for you. You know, that's our goal, is education first and foremost, so that you get comfortable with these words that are going to get thrown around. The franchise investigation process, as you haven't figured out yet, you'll learn there's just a lot of moving pieces. And so having us kind of in that back pocket as a helpful resource on the funding side can take a lot of pressure off of you as the candidate to just not need to know everything and just be fully versed on it, where we can educate you and really get you through some of those really rigorous steps without knowing maybe the ins and outs or the secret, you know, kind of rear view mirror things that are blind spots that you need to know throughout the process.
Well, that's really good. You mentioned a couple things there that I really want to circle back on and hone in on a little bit is the educational process that you're walking through, familiarity with terms, because I don't know about you, but if I weren't in this space, when I'd hear about franchise funding, I'd think, man, I need millions of dollars to be able to buy a McDonald's, and I've got to be able to stroke a check for 7 figures in order to open one of these things. Or I'm passing by a Steak and Shake that looks like it's straight out of the 1980s, and it's a ghost town, and there's a sign that says franchise opportunities, and you only need $10,000. So that's the framework that, unless you're in franchising, you're going to have for what I need to do to buy a franchise. But it's more nuanced than that. So if you could, Brandon, maybe let's start by just talking about, when you invest in a franchise, what are the elements that go into a franchise investment, from working capital to a franchise fee, royalties, and all of that? And what are the main ways that clients that you and I work with tend to finance their business through?
Yeah, I think that's great. You know, a lot of times we do get, candidates, maybe whether they're just online or just kind of sent through whatever process. And they're like, yep, I just need $10,000 and I'm going to be good to go. And then they get into those conversations and they find out that they got to, pay for the construction of the building or pay for some marketing fees, whatever it may be. So $10,000 is kind of just like a knock on the front door in a lot of these regards, if you're lucky enough to have that knock on the door be that low. But yeah, there's so much that goes into that funding process. And what happens is kind of, as what I've seen, as people unpack the so-called American dream, we think of restaurant ownership as the only franchise opportunities. And, I'm sure that you get a handful of people that come through all the time that are like, yeah, like I never saw myself as a restaurant owner. And you're like, well, what if I could open up this whole new world to you and show you these different brands that are home-based, or they are outside of the sphere of just a traditional restaurant knowledge. Now, I know that's where we started with my background, and then obviously talking through McDonald's and Steak and Shake. And oftentimes those are going to have really large project costs, and that's going to be one of those terms that gets thrown around real loosely, and they're going to have ranges as they figure those things out. But what happens is candidates will see, a project cost, let's say somewhere in the range of $250,000 to $500,000. I think it's a good place to kind of park, where I don't know the exact percentage, but I'd say a wide range of opportunities are going to fall within that window. And they'll see that as a candidate and be like, I need $500,000 today before anybody will talk to me. And that's just not the case. And so that's where having a funding partner in the process can be really, really helpful as you're determining your funding strategy. And so, as I mentioned, that educational piece is so important in knowing how to attack this. In FranFund, we have a kind of a multifaceted approach through the educational process. We can talk through SBA loans and what that requires and what lenders are going to look for and what requirements they may want to see. We have another process known as the Rollover for Business Startups, ROBS for short. We always kind of joke, terrible acronym for a really great program. But using your former retirement dollars and accessing those to be used as the cash in your business, tax-free and early withdrawal penalty-free. And oftentimes people are like, man, I thought I could not touch that forever. And what's great about this program is you're actually using that money without it touching your individual pocket, so to speak. So you're not going to face the taxes and fees that you would if you were to just take a distribution. And so, for example, if you have $150,000 available in former retirement, if you were to take a distribution, you'd probably only get about 90,000 of that, depending on what kind of account it is and things like that. But you'd pay those fees and then be taxed on that money. Using the rollover, you get access to the full $150,000 to use as cash in your business to pay for things like the upfront franchising fee or any other fees that may incur that are legitimate business expenses as determined by the IRS, which is kind of just bulky words to say anything needed to start your business. And so a lot of times people will use that rollover money to then help them qualify for an SBA loan. So again, that's why the education is such an important piece. Beyond those two things that we do, and we can always circle back and unpack the SBA loan side, of course, but besides those two pieces, we can talk through and advise on if it makes sense to look into getting a home equity line of credit to help increase your liquidity, to again kind of work in conjunction with another one of these processes, or to allow you to self-fund in a creative way. There's also other options through like a securities backed line of credit, where maybe you have a stock portfolio and you can borrow against that to increase your liquidity without necessarily moving those assets or liquidating those assets, and using that money to then qualify for again a wide range of funding options. And then we have another option through unsecured lending, and that one's going to be a little bit different choice. They're going to have a higher cost of capital, usually coming in at a 10% closing cost. So they're not our first fit for everything, but they can be great for long-term working capital, or if you do come in maybe a smaller project cost, they start lending around the $30,000 mark. And so wide range of options there. And I did want to circle back to the SBA, but just kind of wanted to run through all of those options. On the SBA side, our lenders will work anywhere from 100,000 to 5 million. So, there's a wide range of opportunities. Like I said, falling in line, kind of $250,000 to $500,000 being such a big pocket of opportunity for brands that are in all the networks, in your network, and kind of what we see kind of from all these different franchisors. Having those amounts can be really easily accessible, not needing that full $250,000 to $500,000. The SBA is actually only going to require that you need about 20% of that total project cost. So if you're looking at a $250,000 business opportunity, you're only needing to come to the table with $50,000 of your own liquid to use towards this opportunity, and they're going to fund the other 80%. And the good thing about that $50,000, again, you can use in conjunction, whether it's coming up with liquidity from a HELOC or from the rollover that we mentioned, or maybe you bring in a business partner or a family member that does gifted funds. There's so much to unpack in these vehicles, and that's why it's super important to get into the funding process, as you're discovering, to figure out, hey, there's $250,000 on the table. And Brady, I'll tell you this, and most of the conversations I have, love hearing this. Whenever we get into some of these, we have candidates that come in looking at, I really just want one territory and I want one unit and I want to just stick with that forever. And then they come in and they're like, wow, I qualify for a little bit more than I thought. Maybe if the franchisor has 2 or 3 territories available, then we can really dive in and see those opportunities. And now you went from running that one lemonade stand to now you've got a market of lemonade stands in whatever brand it may be, whatever, franchise or business opportunity you look at. And you got in for really the same price you were expecting. You're taking on a little more debt possibly in the process, or you're using some of your own money, but you qualified for way more than you were expecting. And, I think we can all agree we're getting into business to move forward and grow and make money. And so it's a really cool opportunity to get that funding in the conversation so that you can have everything you need at your fingertips, ready to go whenever you're ready to move forward with, whatever brand you decide.
No, there's so much to unpack there, Brandon. And so if I'm following you right and just reiterating what you're saying, when you think about franchise funding, there's a couple different buckets. There's SBA lending, so that's a loan where there's a 20% down payment for the total project cost. There's a ROBS program, like you said, horrible acronym for a great program, rollover for business startup, where you're taking qualified retirement dollars and instead of investing that in the S&P 500, you're investing that in your new business corporation. And there's home equity line of credit, HELOC, other lending options that are a little bit more specific. But those are kind of the baseline options, if I'm hearing you correctly. So that's a really good starting point. I appreciate you sharing that. What I'd be curious to have you dig a little bit deeper into, as I was getting into the franchise world a handful of years ago and trying to wrap my head around how franchise funding works, you mentioned there's investment ranges from, $50,000, $100,000 up to $250,000, $500,000, even into $1 million. When you say those investment amounts, is that going all right to the franchisor? Do you need to have all of that money on the table right when you sign? Or if that's not the case, what do you get? What are you paying for when you invest in a franchise? Is all of it going to the franchise, or is part of that going to the build out of your actual entity?
No, that's a great question. Yeah. So, as you get into these discovery processes, you'll see a range of numbers just thrown, in multiple different areas. And so when we take that total project cost and unpack it, it's oftentimes going to have many different pieces into it. And it really does help to know, are we doing a brick and mortar build out, or is it going to be a home based service concept that doesn't need a build out? That's also going to help with timing of some of these options. If there's a build out required through the SBA, it might add a little bit of time as you find land and lease space. It's a constantly changing market, and so we see that when people are like, how soon can I fund this? What really matters is what you're funding, right? It makes a big difference. But that project cost is going to be encompassed of that build out piece if it's required. If not, maybe some vehicles that are involved. Are you wrapping any trucks? Are you buying any trucks? Those things are all going to be part of it. And then there's the upfront franchise fee, which oftentimes, if we're talking the SBA route or even the rollover route, because a lot of times those are going to be the first funds leaving as you are paying for the franchise fee for either one unit or multiple territories. The franchisor is going to want you to have that paid following your confirmation to say, hey, this is what we want to do and let's do it together. So then from there, there's other pieces to unpack. How much marketing money is going to be involved? And this can all be outlined in their FDD. How many trucks do you need, right? If it's going to be a big territory, are you servicing multiple trucks or multiple territories with multiple trucks? And then from there, the day-to-day working capital, are you yourself going to be working in the business? How do we outline how you get paid in that process? And then also, is there any just simple working capital added in? Maybe they've seen that 3 months working capital is really, really strong, and that's how their franchisors or franchisees through the franchisor have validated their process, and that brings up a really strong one. I was on a call earlier today, and this potential franchisee was like, hey, I've been validating, and everyone's been telling me that they needed more money to start. And it's probably common sense when you're on this side of it, but when you're in the middle of thinking about it, I've never once heard someone say, hey, I took on way too much capital to start my business. We're swimming in the money. We don't know what to do with all this extra money, right? And so it's one of those things. That's where, again, kind of having the funding partner to unpack, we can say, hey, we're working with X number of candidates, and this is what we're seeing, really, really strong as we package these loans alongside you, and really diving into what that FDD states as the proper pieces to say, this is what we're going to do. When we go into pre-approve, we're likely going to pre-approve on the high end when possible. And so looking at those project costs, it might get a little scary sometimes if you're expecting $250,000 and we pre-approve towards the $500,000 mark, but we do so in the best interest of you as the candidate, because the last thing we want is for you to try to cut every possible cost and then get into business with $20 in your bank account and you got to do payroll next Friday. That's a place we don't want anyone to be. And so with an option like the SBA not having those necessary prepayment penalties, it's usually good to have a little extra capital. Let me rephrase it. It's almost always good to have a little extra capital to be able to keep that business rolling and to keep you comfortable. And then if you do find yourself in the very rare, exclusive position of having too much money, you can pay that loan back because you have the extra capital to do so, and there's no prepayment penalties. But there's so much to unpack in that FDD in just the little pieces. So no, I'd say overall, no, like you don't need that $500,000, that $250,000, whatever it may be, on day one. You're going to need a couple pieces of it to get into the process. Like I said, that 20% is a big, big piece of the SBA process. Or if you're using your rollover, getting that 20% in a funded account and moving forward with those franchise fees is totally part of the process. You put pen to paper and then you move forward with the loan packaging, getting everything in line to then get your business open. It's very rare that someone signs on a Monday and opens on a Tuesday. It's going to take time throughout that process to get the funds moving and going from there.
Like you said, you're never going to sign on Monday, open on Tuesday, and get going. So really, I'm a simple guy. I try not to get bogged down in the details. So the way that I've made sense of this, Brandon, I think you did a great job hitting on this, is you've got a franchise fee and other funds that are due at signing. And a franchise fee, I like to liken that like a down payment, right? You're paying to do rights as this franchise in the agreed upon territories. And then you've got working capital, and that's all the pieces on the back end that you need to build a business that you need if you were building a food business, a in-home healthcare franchise, a physical therapy franchise, a mobile dog grooming franchise? What are all the pieces of equipment and working capital from marketing to staffing to payroll that you would need even if you weren't doing this as a franchise? And I think that's what people don't always understand. As a franchise investment is not just going straight to a franchise. You're investing in a business that, hey, you know what? If you wanted to start your own mobile dog grooming franchise, you need to buy vans, whether you're doing it through a franchise or not. And that's part of that, but that doesn't all come out right at once. That's a slow burn over that first 12, 24 months of getting to operation. So
Yeah.
appreciate you sharing that, Brandon. One thing I'm just going to say the quiet part out loud. A lot of people get freaked out when you say 401k, and I'm not 65 yet. And I've been taught it's common knowledge and oftentimes good knowledge and good wisdom. Don't touch your 401k until you're 65. And now we're talking about 401k as an option on the table. Debunk that myth for me a little bit, because I know it's an option that for some folks really is able to open the door to business ownership and franchise ownership that otherwise would probably be closed.
Yeah, and I think there's a lot of myths surrounding it. I'm not 65 either. I hope I don't look 65. But, as we're kind of going in that process, I tell people all the time, like whenever I say, retirement can be an option, I can almost feel their palms sweating through the phone, right? As we're talking, I'm like, I know where this conversation's headed, and it's okay. Let's just be uncomfortable for a minute. Let's talk about it and let's unpack it. And the reality is, whether it's $250,000 of your money or $250,000 of the bank's money, it's still $250,000. It's a lot of money. We're talking about big, big values. And so we do need to be a little considerate of that. But as we kind of go deeper into those processes around, well, what I hear on the SBA side is, I want to be protected. I want my investment to be protected. And I think, if again, we kind of let common sense be on the table, it's business ownership can be risky. And, anytime there's a conversation around business ownership, it's always surrounded by, if it could fail, and we don't like to use that fail word, but on one side with the retirement money, it could also help you succeed. It's a quicker path to funding. You're investing into your company as if it is an investment into, say, like an Apple stock, where they're getting access to that capital to grow their business. Now, you don't usually think of yourself as Apple or any of the great products that they've presented our society with, but their stock runs the same way that yours would, except it's not going to be on a public exchange. It's going to be a private transaction. And essentially what happens is you create a C corporation, and then that C corporation allows you to purchase shares with your retirement plan. And so whether you're fully funding it or half funding it or whatever amount makes the most sense for you, you're using that money to be invested in a qualified retirement program. This isn't some let's move money and hide it from the IRS. This is actually backed by the IRS and the Department of Labor. And so they use this tool and allow us to use our retirement plans to invest in the startup of a company. And so it can be scary because you are using that money. You are going to actually convert it to cash and use it in your business. So it's no longer going to be invested in the Apples and the ETFs or whatever it may currently be invested in. But you're going to have that access to that cash. And since it's invested in your company, as your company grows, that retirement has the opportunity to grow. So let's fast forward. You've had 10 years of business ownership. Maybe you put $250,000 of your retirement in, and you're ready to sell your business. And $250,000 bought everything, just to make it easy. $250,000 was your all in, and you go and sell it. And let's say you've grown it, and the territories are booming, or the unit is booming, whatever it may be, and you're ready to sell it, and you get $1 million offer on this project, and now you sell it. The way that would work now is that you have $1 million that goes straight back into your qualified retirement, whether it's in an IRA, or you can choose to roll it over again, work with Brady again, get you a brand new brand and keep rolling, or you can just be, like I said, simple IRA, whatever qualified retirement works for you. And now that money has grown from $250,000 to $1 million. And over the life of that plan, there's so much to unpack about what options you have as a business owner, but you're able to pay yourself. You're able to fund your business in a debt-free or kind of a debt offset period, right? Because maybe you are using it alongside a loan. In this case, it would be debt-free that you're using it. And there's no required payback on this monthly. So where an SBA loan is going to have a monthly required payback as soon as that loan closes, there is no required payback for the rollover plan. So you're actually starting your business debt-free. Another big piece is credit score doesn't matter in this regard if you're using just the rollover. So you could be in a space where, maybe who knows, life has happened to a lot of people that we work with, and maybe retirement is all you have access to. That'll help you get into business. And again, just kind of getting into these things and unpacking them can be super helpful, because there are a lot of options along the way to pay this money back. Even though you're not required to, there are options to put this money back and kind of mitigate that risk over time. So maybe you're not waiting 10 years for your business to sell, but you as the individual are actually buying those shares back and moving that money back to qualified retirement, maybe in 3, 4, 5 years. And now you've grown your retirement, you've paid yourself along the way, and you've replaced that money. So now not only do you have a debt-free business, I think it's easy to say if we used our retirement, we probably feel some burden to the money inside of that business. So if you've been able to pay it back over that time, you've now released that. And now you've got a truly, truly, and I'm putting debt in quotes here because it's not debt, but a truly open business that it's cash flowing and it's working for you. And so a lot of pieces around it. There's a lot of structure involved, and there's some ongoing maintenance that's required because you do open a retirement plan inside of this. But it can be a really strong strategy. What I tell people when they're thinking through this as an option is it's a really, really great strategy. It's not for everyone, and we have to know that as well going in. It's got to make sense. We recommend not doing it for less than $50,000 for a multitude of reasons. The main one being that the cost doesn't make sense to then just go and take a distribution and take those taxes. But anything over that $50,000 range, it can be a really strong strategy. So something certainly worth digging into, as just maybe you don't want to be tied into debt and you want to use your own money and kind of offset what you're currently invested in.
Well, I appreciate all that. As I've gotten more into the franchise world, it's helpful to have people like you explain this to me. And in full transparency, when I got into this industry, every time I had a conversation around funding, I'd call a funding consultant and say, hey, I think I just screwed up in how I explained this. Can you help me? So if your head's swimming a little bit, feel free to just press replay real quick. The more you're around it, the more it makes sense. My father, Todd, who, if you're a client of ours, you certainly know, he bought our FranNet business 14 years ago. I'm the second of 4 kids, and I was in high school at the time. We were staring down college. My parents were certainly staring down sending 4 kids to college, and they needed income, right? And their biggest asset was their 401k, and that's ultimately how he bought this franchise business, this FranNet business that I have the opportunity to be a part of now. So for him and my mom's financial portfolio, that was what made sense for them at the time. My mom, being from a Procter and Gamble background, very fiscally conservative, she had some holdups that she certainly had to work through, but it ultimately was a great thing for our family. Like you said, Brandon, always want to reiterate, it's not for everyone. Different people have different portfolios. People have different comfort zones, and that's perfectly fine. And we always want to make sure that we respect that. And FranFund does a fantastic job of walking through a consultative option or a consultative process. Here are our options. What makes sense for you and for your family and for your team that's going into this. As we kind of wrap up our conversation here, Brandon, if you could, we've thrown out a few different numbers. If I were just to ask you, how much does a franchise cost? I know that's a very oversimplified question, but it's a question that most people have. How would you answer that question? And if you could maybe categorize different buckets of low cost, medium cost, high cost franchises, what are some numbers around that? And what are the types of businesses that typically fall in those categories?
Yeah, no, that's a great question. And, we get that question a lot, and oftentimes what I find is they'll have a conversation with you and then they'll run some numbers by me to make sure everything's right. And I'm like, look, everything's pretty buttoned up, right? So, I'd say low cost, there are options in the franchise world, that you can get in realistically for as low as $30,000 to $100,000. Maybe it's some of your vending opportunities. That's kind of where my mind goes when you go that route. And those can be as simple as putting up one unit and running just your typical vending business, to kind of having a vending empire. And that could range all the way up to as many as you want. But that's going to be one of those lower cost, lower barrier to entries. And honestly, if we're looking that route, we're going to go rollover. For anything under $100,000 is going to be a really good place to start talking on how to fund that, because our SBA lenders just won't go under $100,000. And then with the 20% required, the project cost really goes up to about $125,000. And then I'd say probably low cost would be at that, 125, probably to, 300 ish. 250 maybe to be a little more conservative, and those are going to fall under that home service umbrella, maybe 1-2 territories. When I say home service, thinking through any of the brands that service an area of your home: air conditioning, window repair, window cleaning, plumbing, those kinds of brands that you see. Usually it's a van. Maybe it was a mom and pop back in the day. Now it's kind of moving into the franchise world. Restoration services, kind of, again, one van, one territory possibly. And again, the big thing that I'm seeing now is how many territories are we looking at? That's going to change that low investment to maybe one of those middle ground investments. And the middle is a wide middle, I find, in franchising. I'd say it's that 300 plus, maybe to 750, which sounds like a tremendous amount of money. And don't get me wrong, it is. But when you think about combining retirement strategies that we have available through the rollover with an SBA loan, getting that 20% number at a $600,000 to $700,000 loan is only, and I say that more tongue in cheek, but it really is only $100,000 to $150,000 of your own money getting put in to acquire 3, 4, 5 territories and start opening those. Maybe it's a brand that hasn't sold out in your area or doesn't have any competitors in the area, and you kind of want to take a big chunk of that market share. And so home services, again, fall into that, but you're also going to start opening into some brick and mortar opportunities. Maybe not full on restaurant opportunities that have big equipment packages. There are some at that investment range. Usually the big restaurants would go into the higher end. When you start talking McDonald's franchising, which, I haven't personally worked with, they have their own bank at McDonald's. So they do their own world of funding there. But that's going to be your million plus, and million plus is going to be big end loan ranges, usually going to have a business partner, maybe not always, but oftentimes. And then you're using a combination of strategies: cash, retirement, and SBA, just for the average client. Now, if you're a seasoned business veteran and you've got multiple businesses under your umbrella, you've probably got more assets that you can kind of put at work and move around to liquidate. You're also maybe already working with a private lender at that point, or have your own SBA lender. So yeah, I'd say kind of what we see most of our business in, and we're comfortable working with any range, especially on the education piece. That's the super important part. You hit on it. I want to hit on it again. Just our goal is to be as informative and as educational as possible. We sell products, right? We work with the loan side and with the rollover side. But if it doesn't make sense for you, we don't want it to make sense at all. We want it to be what works for you to get you into business. And so if that's on the low end, we'll refer where we can and make sense of what we can. If it's in that medium range, that's going to be just most everyday clients that come through working with, looking at something in that real good range. And then, if it does go to medium range, maybe they didn't know what they qualified for, or maybe they're just like, found some mattress money. We have that too, where they're like, I didn't know I had that. I haven't looked at my accounts in months, and then they're like, oh, I have a ton of money to use. It happens. It's a phenomenon in the funding side, but we see so much where people are like, wow, this is actually a lot more affordable than I thought it was. And now I can pursue my dream in an appropriate and a functional way that makes the most sense for me. And then we have happy franchisees, but we also have happy franchisors as they're getting into business and keeping the entire marketplace of franchising in a really good place, because people are winning in terms of starting their business and continuing to grow the industry kind of full circle.
That's great. I appreciate you sharing all that, Brandon. As we wrap up our time, I always want to reiterate this. The reason that FranNet exists, the reason that FranFund exists, is the reason that franchising exists is we exist to go into business for yourself, but not by yourself. And that needs to start, if you're really doing this right, from the due diligence process, from the franchise research process. And that is why we exist, is we want people to feel like they have a team, that they're going to the table, finding a franchise, funding a franchise, going in with their eyes wide open. And it's really difficult to do that by yourself, especially if you're new to franchising. And so Brandon, FranFund, huge fans, huge advocates of what they do. They're such an extension of our team. We like to think of ourselves as an extension of their team as well. So Brandon, thank you so much for all that you do for helping people achieve the goal and the dream of entrepreneurship, of business ownership, and appreciate our partnership, man. And we'll keep the ball rolling here.
Yeah, absolutely. Thank you. Thank you for having me on today, and look forward to continuing the conversation along the way.
Awesome. Thanks, Brandon.
All righty.